Alrighty, folks, it is my true pleasure, my true honor to have this man in our school community. He's obviously a huge part of One Rental at a Time. We talk almost every Thursday. He is essentially the author of the Zuber Letter. He does a lot of great work putting that together and publishing each week. So again, we'll meet some people. So I am pleasure of mine to introduce Lance Lambert. How you doing, Lance?
Doing great, Michael. Thanks for having me.
Absolutely, man. Well, let's talk for 10 minutes before we let everybody ask questions. Folks, remember, this is your chance to ask about your state, your city, your buy box. Lance has all the data. But Lance, let's remind people how long you've been doing this. What are your data sources? Why is the thing you have put together just so valuable? Let's give us a history.
Yeah, so I had been a data journalist and a financial journalist at publications like Bloomberg and some other outlets. And in 2017, I went to work at Realtor.com. It was a part of a career pivot where I was going to move into data science and get out of journalism. And the couple years there, it was every day just running analysis on real estate data across the country. And it's not just the Realtor.com data, it's also all the proprietary data that their company and their economists buy as well. And a couple years in, I was like, you know what? I'm going to leave. I want to stay in journalism. I went to go work at Fortune magazine. And while I was there, I wrote a data newsletter for Fortune 500 executives and CEOs. And around March 2020, of course, we had the lockdowns and then the pandemic housing boom occurred. And during that period, there was a real interest from readers to like explain like what is going on, right? And they wanted better data that kind of was a little deeper than some of the generic news headlines, right? And there's a lot of garbage out there, and there will always continue to be a lot of garbage in the media headlines for housing. And so I kind of got sucked into it. And a few years in, I was like, you know what? I'm going to leave and just build my own niche news and research outlet that just focuses on the US housing market, tries to put things in perspective. Because if you look at this market, there is so much nuance between what's happening in the mortgage market, what's happening to home prices, and across the country, and then also, like what's happening in single family home building. And so my whole goal is to try to connect those dots and then also provide deeper data and analysis so other people can kind of connect the dots in their market.
One of the things that I love that you're doing here is obviously REI Club. I'm a huge fan. You obviously have the free version, you have the paid version. But something I don't think you and I talk enough about the paid version is not only the additional 2 articles, but it is actually access to your data. And I have a very strong opinion and hope that people watching this ask questions just to get a taste of what you have there. Because again, if you're going to follow One Rental at a Time, you've heard me talk about a buy box a million times. I think it is everything. Also, you've heard me talk about folks that are in expensive markets, and maybe you've learned the skill of learning your market, but you want to go somewhere else. And having access to not only current data, but historicals is extremely valuable. So why don't we just paint the picture one more time of just how long you've been doing it? Maybe let's give them a flavor of just Fresno, California. We'll start there. But folks, remember, raise your hand if you want to ask Lance a question. You could put a question in the comments and I will read them, folks. This is your opportunity to talk with the man, myth, the legend. Don't miss out. So, Lance?
Yeah, Zuber, are you fine if I share my screen and walk
Oh,
through my stories?
absolutely. Absolutely. I'm sorry. I need to give you access to do that. My bad. I just did.
Awesome. Okay, let's see. Is it sharing?
It is. Yep.
Okay. So you want to see Fresno, right?
Yeah. Why don't you start there? It's my market. If you want to start at Fresno, and then maybe if you have a zip code, we could do like 93728, something like that, if you wanted to.
Yeah, I haven't updated my zip code report. That's
Okay.
coming early next week, but let's look at inventory metros. So this
Perfect.
is pricing data. This will get updated this weekend when Zillow drops the latest data for full month of June. And what I have here is access to my home price tracker, access to the inventory tracker. This has the raw data for 800 metros, 3,000 counties.
Yep.
But then I also, every time I send these out, I also have a report. So like this map right here, it shows year over year across the country. And then all of my visuals, anytime I have a chart or map, you click above and you can see the interactive. This is always best done on a desktop just because, mobile, sometimes it's hard to like zoom in if you want to do it like this.
Right.
So counties, what county is Fresno in? I
Fresno
don't,
County. It's
Fresno
up,
County.
up, up. There you go. That's it.
So between May 23 and May 24, Fresno's up 5.7% year over year. And
Mhm.
so these home prices, every once in a while, I will do a report, and I think Zuber likes this one, where it's looking at the bottom third of the market, the middle, and the top
Yes.
third.
You are the
The
only guy that does that. That is the report that matters in the market we are in. We have a bifurcated housing market. You're the only guy reporting on that. It's awesome.
and so this part right here, this is just the middle of the market. So the bottom
Mhm.
35th percentile to the top 65th percentile. So really the middle.
Yep.
And some of the weakness in the market is some of these rural counties in Texas and Louisiana. And we're starting to see some more softening around the coast, some coastal parts of Southwest Florida. Um, and I also have a separate report every once in a while where I will break out single family and condo. And one thing we're seeing in Florida right now is that single family has been fairly stable in prices, even in the weekend areas, with the exception of maybe like Punta Gorda. But it's really the most of the softening is happening in the condo market. That's where most of
Ah,
the
interesting.
fall. Yeah, so year to date, 20 of the 26 metros in Florida are down year to date for condo prices, but it's only
Hmm.
like six are down year to date for single family.
Yeah, it's
Uh,
it's these nuances that a lot of the housing or what I call crash bros. Hey, we're on my channel, so I'll call them crash bros and the doomers. They're not picking up these nuances. They're just taking the most negative headline and putting it out there.
And so this map now is metros.
Mhm.
This is the 300 biggest metros in the country. I size it by amount of inventory available for sale. So you'll see like New York City, MSA, Miami, the bigger metros usually a little bit bigger. And here you see most of the weakness on prices is really Austin, New Orleans, Punta Gorda. It's around the Gulf. And so not only did they get hit by the overheating in prices, the mortgage rates going up. There's also the factor of home insurance shock, and they have more home building in the Southeast and Texas. And so, given that the builders have done some of those affordability adjustments, and there's the mortgage rate buydowns, it's just moved enough buyers, some of those first-time buyers, to new construction versus
Mhm.
resale to create a little more softening. But this is actually very normal. You'll have this in a lot of housing markets throughout history where a lot of markets are up and nationally is up, and then there's a few pockets for a certain number of reasons where they're down a bit. And so the most strength right now in terms of price growth for single family in particular is the Northeast, the Midwest, and Southern California. And actually, surprisingly, Silicon Valley has been very strong. San Jose's up 12.7% year over year.
Crazy.
After there was a bit of a correction there when rates went up really fast, but I think it's some of that AI boom and the fact that
Oh, it
stocks.
has to be. Nvidia's added $1 trillion in market cap. They have a lot of employees who have a lot of sudden wealth out there buying single family homes for sure.
And then if you're not as much into the maps, you're more into the tables. These are my six favorite cuts of the data. So there's month over month, what just occurred, and we are passing through the seasonally stronger window in terms of the reporting. This is a little lag. So out in the real world, we're kind of moving through the softer period, and the data is always just a little step behind. And then you have year to date, what we're up since December, year over year, again, San Jose is the strongest, and New Orleans, Texas, San Jose is the weakest. Shift since 2022 peak, down from peak, and since March 2020. And so, why that matters is you can have a market like San Francisco, or let me see if San Jose is still in this bucket, barely, but San Francisco is a better example where the market, you will still see headlines that they're down from peak. But if you look at the data year to date and year over year, it's actually positive growth now.
I could not.
And
If you would have asked me that, I would have lost money. I would have thought San Francisco was down year to date or at least year on year, and it's not.
I
That's
bet there
wild.
are still some pockets in that market where if we dug in deeper, there probably is. But I think it's a lot of like the fact that, the the tech stocks are up so much, the AI boom. But yeah, it's surprising. And then I always make sure to have a national figure in here to put the national perspective. So nationally, we're up in the Zillow index 3.9% year over year and 2.2% above the 2022 peak, despite
Wow.
mortgage rates going from 3% to 7% and still up 44% nationally since the start of COVID. And then you have a market like Austin, where you will see a lot of these bigger headlines where, hey, they're down quite a bit. But if you look at the numbers closely, the rate of the declines is slowing in the Austin MSA, and it is more concentrated out in the deeper exurbs where there is a lot more of that new construction. And so for
Mhm.
this table, I just showed the top 50, but if you click the link and you want to type in your market, uh, I live in the Cincinnati MSA. And then if you wanted to just do your state, uh, you could type in and see your state there.
Oh, wow.
Let's take another cut of the prices. So this is down from peak. Most of the declines actually happened in the second half of 2022. So there are some of the markets, especially in like rural areas, Mississippi, Louisiana, Texas, down more. It's interesting because Northern California is now rising for prices, but there's still some down a bit. And then
Mm.
Southern California, it weakened initially during the rate shock, but now they're at all-time highs. And so
Wow.
most of the country from Minnesota over to Maine and then really down into the bottom of Georgia and maybe even some parts of Florida are at all-time highs essentially for prices, despite rates going from 3 to 7%. And
Mhm.
this is another version of this just for the metro levels. So you can kind of really see what's happened since 2022. Now, if you want to go in deeper into the data and you click here, you will go into the actual price tracker I have. This is a beta version, so eventually this will be in a dashboard and
Mhm.
not in these Google spreadsheets. But right now I update them here. And so in this, you can see every metro in the country, over 800. You can see how much they're up 20 years, 15 years, 10 years, 9 years, 8 years, all these different cuts for all
Wow.
these different markets across the country. And then you got the county level data. This is for over 3,000 counties in the country, going back 20 years. If you want to go back 40 years, I can't do it down to the county level, but I can do it for about 400 metros using the Freddie
Mm.
Mac data. And so if you want to see how much prices are up from a 40-year lens, kind of get that real deep perspective, you can go in there. And then if you want the raw data, you're like, Lance, I don't want to see your cuts. Just
Mm.
get to the actual raw data. I don't think many people use this as much, but you can go into the raw data and see for metros and counties going back to like 96. And then if you want to go back 40 years using Freddie Mac for state or for metros, you can go into the raw data going back to January 1975.
Nice. Nice.
And that's the price tracker. Then I also have my inventory tracker, which will get updated today. Give me a second. Do you want to go through the inventory tracker or do you want to
No,
look at some?
just again, opening this session again, folks. Remember, raise your hand, put a comment in if you want us to dig into your buy box, your city, your state. This first opening, we're just highlighting all the value that Lance provides out there via Resi Club. So, yeah, just do the inventory one, and we'll get to the questions in a moment.
Okay, sounds good. Let me see. I'll go through this one a little faster because it's all the same data. It's just for, or all the same types of cuts. It's just for inventory and set prices.
Got
And
it.
so, in my view, it's really important to look at the housing data through a lens of where we are now versus where we were in 2019. I think it's a really strong comparison. The
Absolutely.
statistical analysis that I've ran has showed it's strongly correlated with price growth. And so the markets that have made it back to 2019 levels, they either have some declines or just really flat, right? And then the markets that have stayed really far down for active inventory are the markets that are still elevated price growth or even maybe borderline overheating.
Mm.
And so if you look at the country right now, you will see a lot of headlines about inventory being up a lot percentage-wise, and it is true, it's up 35% nationally. But if you look deeper at it, it's still a lot of the country is still down for active inventory right now from
Wow.
pre-pandemic levels. And
Wow.
so really the Northeast and the Midwest and Southern California and then parts of like New Mexico have stayed fairly tight. You have seen more softening in Texas and in Florida. And then this is a metro level cut it looking from now versus pre-pandemic. Again, it's more of like the Gulf that has kind of gotten back, parts of Arizona, some areas in Colorado and Idaho. Really, those are a lot of boom towns that either saw prices just go up so fast, it's kind of strained the market for locals. It's gotten too far detached from incomes for a bit.
Yep. Hmm.
The other thing is just they have a lot of new construction, like I mentioned earlier, and that's kind of competition with the resale market.
Right.
Still, but then even if you made it back to pre-pandemic levels, we're not talking like '08 levels of inventory. From a historical lens, it's still very fairly low. And a lot of these markets that have gotten back to pre-pandemic levels, still many of them are only at 4 or 5 months of supply. And
Yeah.
so here's 5-year cut, 4-year cut, 3-year cut, 2-year cut, 1-year cut. You'll see that the markets that are the tightest are like Hartford, Providence, Chicago. It's a lot of these Northeast and Midwest markets. I mean, nationally, we're still down 33% from pre-pandemic levels.
Wow.
But it's as you go up and you get to the markets that are above pre-pandemic and have kind of even gone a bit above pre-pandemic, like Austin, those are the markets that have softened more.
Yeah, it makes a supply and demand at work. Absolutely.
And again, all these charts are usually interactive. So if you want to click on them and see different markets, this one actually, okay, it's loading. So if you want to see what I mean, here's Austin that gone up
Wow.
a bit. But then if you want to see on the other end of the spectrum, Hartford, Connecticut. And if you remember looking at my pricing chart, Hartford, Connecticut is up 11% year over year. And if you look at their active inventory, still very tight resale market. And then if you go
Man.
back to Austin, then you check Austin, that's the one still down 4.1% year over year.
Mm.
And so how I view active inventory is it's kind of like, think of it like a car dealership lot, right?
Mhm.
It's everything that's actively for sale, right? And
Mhm.
that car dealership lot can get more packed, not necessarily because a ton of homes are getting, or a ton of cars are getting delivered to the lot, but also if just fewer people are buying homes, right?
Mhm.
So active inventory is not just a supply metric, it's really an equilibrium of supply and demand. And right now, what we're seeing is that rates are very high. And so that has priced out a good number of buyers, but it's also priced out a lot of sellers. And so not a lot of cars in this example are getting delivered to the lot, not as much are getting bought, but for some markets, unless your demand is pulled back even more, you're not necessarily getting the active inventory to build. And that's what you're seeing in Hartford. Hartford, just like everybody else, has seen mortgage rates go from 3 to 4 to 5 to 6 to 7%, but active inventory hasn't budged. And it's because demand is pulled back and supply is pulled back. But if you look at a market like Austin, what's happened there is demand got pulled back and supply got pulled back, but there's
Mm.
this additional supply in the market from the new construction. So that's kind of helping with more supply. And then there's also the fact because Austin saw so much money pour in from like San Francisco, Los Angeles, Seattle during the pandemic boom, Elon moved there, Joe
Mhm.
Rogan moved there, right? It was really soaring. Home prices there at one point were up 40% year over year.
Oh
That's
my
only
gosh. Year
that's
over
only
year?
2 times in history. Yeah, Boise during the pandemic and Austin. It didn't even happen during the run up, previous run up. And so prices there just went up so high so fast that once that demand flow into the market, that pandemic migration slowed, they were just a little too far beyond fundamentals. And so it created a bigger pullback in demand. And so active inventory was able to build up a bit. And so I view these two trackers, if you take them together, you can get a really robust view of what's happening across the country for metros and counties. Uh, Now, I do have deeper cuts that will sometimes get into the zip code level data and then also getting to the price tier data. But the one thing I will say about zip code level data is that you can get more noisy, right?
Mm,
And so if you open up the zip code data, sometimes it can show a really big percentage move just because a small zip code, if it has a weird monthly print like
yeah.
that, it can fluctuate a bit. So I like the county level data, get the gist of it, and then you take it a step deeper. And another thing I like to do is I round up all these different forecasts that aren't publicly available. So like Moody's Analytics, they don't publish their forecast. I have to actually email their chief economist, Mark Zandi, to get it every quarter. And so right now, the most bearish outlook for home price forecast for the next 4 years for national is Moody's, and the most bullish is Goldman Sachs. And
Mm,
so I like to take them, put them into charts, and then also reach out to them to get explanations for why do you view this, right? And Goldman Sachs essentially believes that, yeah, affordability is not going to be great. And yeah, they think rates could come in a bit, but they think prices are going to continue to rise. And so despite that strained affordability, though, they think that the fact that supply will remain tight, they believe, will keep prices moving up. Whereas Moody's take is a little bit different. They also believe mortgage rates could come in a bit, but they think as some of those sellers kind of finally have to sell, whether from death, divorce, children, job change, and then the fact that lower rates maybe unlock the mortgage rate a bit, that just that little bit of extra supply they think will help to pretty much take us sideways for a few years.
yeah. I love all
And
of this. Yeah, I love all of this. We'll get to some counties that people put in. I actually just before we do that, I want to go to a tweet that you sent out an hour ago. Obviously, folks, if you watch the daily financial news, we got another great CPI read. All four metrics, month on month, year on year, headline core were lower than expected. I actually anticipated that rates might go to 6.9. Lance just put it out. They went to 6.85, the lowest reading since March 8th of 2024. The spread, again, is 267 basis points. That was a wild move today, down 14 basis points, Lance. Crazy.
yeah, and lowest since, like you said, mid-March. And so for the year now, our range is from 6.63 to 7.52 for the average 30-year fixed mortgage rate. So we're now kind of in the lower bound of what we've
Yeah.
seen this. And it'll be interesting to kind of see if the market continues to price in more disinflation and more rate cuts, if that can kind of start to take out some of the volatility in the bond market and
Mm-hmm.
maybe pull down that spread a bit. Because right now that spread, I think I put it out, what is it, 2.69 today? And the historical
267, 2.67.
2.67, and the historical average is 1.74. So
Yeah.
if we just came down 50 basis points on that,
Yeah.
even without the 10-year coming down, we could be closer to a 6.3% average 30-year fixed mortgage rate.
No, absolutely. One of the things I do on Thursdays is I talk to Convoy Home Loans, and they're actually right now pricing with points loans in the fives, in the high fives, if you're going to pay some points. So it's going to be very interesting to watch this spread, uh, you know, hopefully reduce. I do think there's going to be a lot of people, forecasting rate cuts, all of that, but we won't get there. So you want to show something else before we look at some counties?
No, I'm just kind of scrolling through to show people different amounts. Where do you want me to go next?
Oh, actually, I love this chart. This is my inflation's a feature, not a bug. This is the chart right here that when I see this, I just smile. Yeah, by the
Yeah, and
decades.
so throughout history, inflation's always there. Even during recessions, inflation's still moving up. We are off to a faster start for the decade, but that has since decelerated a bit. But yeah, it's just a constant feature of the economy.
Yeah, absolutely. Love that. So the first county we got, Lance, came from David. David asked about a county in Michigan. I'm going to butcher this one. It's in the chat. Lenawee, Lenawee, is a county in Michigan.
Okay, I'm a terrible. So what? Can you spell it? The first bit.
Lenawee. Awee.
Okay, I
There you
found it.
go.
Okay,
Oh, look
so
at you.
that county over the past 20 years is up 101%.
Could you
Past,
scroll up a little bit so it's just not at the bottom? Sorry.
yeah, yeah.
There we go. So it's more visible. There you go.
And so that county is up 103% over the past 10 years. Although that's up about the same for the 20 years. I think what the data is telling you there, if I went and looked at the raw data, is they must have had a pretty big bust in that
Mm.
market, which Michigan, I think that's probably true.
Hmm.
But constantly growing. Let's see here. So since over the past 5 years is up 45%. The past 2 years is up 5.78%, and the past year up 7%. And shift from the peak is 3.93%. And so let me go look at what its active inventory looks like.
So that was price. Thank you for that. Now we're going to go look at inventory. Thank you.
Let me just make sure I'm looking at the column right. Yes. So I can see why its prices are still rising.
There you go.
It's down 60% from pre-pandemic inventory levels. Um,
Wow.
and this growth in the active inventory just isn't that high there. Yeah, I could go look at the raw if we wanted to.
Yeah, why not? Let's just, again, part of the things I want people to realize, if you're going to get serious about a buy box area, the only man that has all the data is Resi Club Lance Lambert. So that's what we're giving you a taste of.
And if you want more than just active data and pricing, in the inventory data, you can also get days on market and new
Oh,
listing for all these different
wow.
for all different counties and metros. So
Oh, I see the
let's,
tabs. Yeah, look at those tabs. Yeah.
new listings can be a little trickier to read in terms of like what it's telling us. The active one though is so strong right now, especially if
Yeah.
you look at that 5 year column. It doesn't miss a lot in terms of its relationship with the pricing.
Mhm.
Yeah, not a huge number of listings in the market. There's 174, and that was in June. So I just
Mhm.
updated this last night, and I will send out the bigger deep dive on it later today. Give me a second, and let me
Mhm.
see what it was in June 2019.
447.
Yeah, 447. So down 60%. It's still up 3.63% from peak, and it's up 7% year over year. I would classify that as a tight resale market.
Yeah, for sure. For sure. Again, folks, we'll look at more counties if you put them in, but we got a question from Kevin, really talking about finding a buy box in Atlanta. He's trying to, ask folks for advice and help. So what I would tell Kevin in this example is, uh, in the beginning, Kevin, it's pick one. Get consistent, get a tight buy box. Don't look at multiple counties, multiple zip codes. Get focused so you can start tracking data. You can start feeling it out. Also, second, if you didn't already, Kevin, there is a Wednesday at 6 p.m. Accountability group. If I was just getting started, the session that I would make sure to follow would be the 6 p.m. Wednesday. That's specific with old guy REI and a lot of people on this call. Get in the accountability group, introduce yourself. Don't be shy. Everybody in there knows one rental at a time, knows buy box. They will help you, Kevin. So make sure you join that as well. Go ahead, Lance. You want to say something?
Yeah, and the other thing is I try to do is keep people up on like what are areas of opportunity in Resi. And so like one of the things that I'm still very bullish on is build for rent. It's where the institutional capital at the moment is still going. And a lot of these institutions have pulled back fairly hard from buying scatter homes in terms of like going out competing against you guys, the single family landlords. Instead, they're going to the builders directly. And I had a conversation a couple weeks ago with the head of Build for Rent for American Homes for Rent. That's
Mm.
almost all they do now is build
Right.
for rent. And so of the 60,000 rentals that they have, 10,000 as of Monday are from Build for Rent. And they have another 10,000 in the pipeline. And if
Mm.
you go look at their data, 95% of all their new acquisitions are built for rent. the last quarter. And so that's one thing I try to get into is like what's kind of going on across the market. I try to talk to these different CEOs and get people intel.
Yeah. I think it's always fun, and I'm glad you do this. And frankly, people may not know this, but your access to C-suite across public, across private, you're getting chief economists all the time. You've been in the journalism space for a long time. Your reputation is second to none. So they return your calls, they give you time, they allow you to interview them. And what that does for me as a mom and pop landlord is it tells me where they're going. So A, I don't get run over, and B, I can kind of skate around them, right? I could be a little speedboat while they're the battleship. Says I don't want to get run over by a battleship, but I don't mind being a speedboat around them.
Yeah, and so some of the things that I do are probably fairly useful, like the buy box stuff for counties and
Mhm.
metros, the inventory tracker and the price tracker. I think that is super helpful for understanding a pulse of your market.
Yep.
Then there's also like getting the intel across the industry, what's happening. And then some of it is just kind of like fun stuff too. So like Morgan Stanley is arguing right now that this cycle, homeowners are the strong hands, essentially. And so their case is the fact that 40% of homeowners in the US have no mortgage. And so like we go get the data and we get it also down to a county level across the US. And also, a part of their argument is that of those who do have a mortgage, 96% are fixed rate,
Yeah.
and 40 or half have a mortgage rate that's 3.9% or lower.
Right.
And then if you look at the LTV, Mike Simonson had a great chart. Those who do have a mortgage, they have an enormous amount of
Yeah.
equity.
Mike put it out yesterday. 48% is the average LTV of a U.S. homeowner that has debt. That is wild to think about. It used to be 70%. Today it's 48.
Yeah, and so I try to get very quantitative data that kind of pushes back at some of these headlines you'll see out there from time to time.
Yeah, it's pretty wild. So we got another question about Chicago. This one's a zip code, so I don't know if what we're going to be able to look at the zip code level, but hey, we'll give it a shot. Zip code level 60619. It's a Chicago area. I don't know what you have. It's kind of zip code level.
Yeah,
Maybe we take a
give me a second. I haven't updated my. Give me a
right.
second.
It's a month old, right? The new update's coming soon, but it's just a taste of what's coming.
What market do they want?
It's Chicago, zip code 60619.
1 second. I accidentally clicked the Northeast.
It's okay.
Yeah, I still need to get a bit better on how I'm doing this zip code. And the other thing is, I just launched this in October, so this is my beta version,
Right.
and I'm going to continue to get better in terms of how I'm going to visualize this for people.
There it is.
Although the pricing for it is locked in, grandfathered forever. So whatever price you get in, even if I have a more advanced dashboard over time, it's still the same pricing.
Nice.
It'll never go up. Okay, so I forgot to put the search bar on this.
It's okay. So
What's
60619, Chicago.
oh, what is it?
60619. 60619. Yep.
Give me a second. I got to see where it's at.
Okay.
So I can find it quickly in the other one.
So South Shore looks like. Oh, there it is.
Okay. Okay, it's just under Hyde Park. What is it?
60619. There it is. The top
Oh,
red. Ah, so what's going on there? County. Looks like.
and that
There you go.
no, that's the zip 60619, right?
Correct.
Interesting. So I'm seeing a bit more weakness in this pocket just south of Chicago. The metro as a whole is very tight still for resale inventory and prices still moving up. But there is more active inventory down here, and I've seen in the past, and there is a bit more price give up.
There you go. Time for disrespectful offers. That's the
Yeah.
kind of data you can look at here. And again, it's very regional. Most of that country or most of that state's blue. But again, if you have a buy box that's tight, again, 60, whatever it was, 60619, I would look at that as an opportunity to write disrespectful offers.
So what's true right now in a lot of the Midwest and Northeast markets is the donut outside of the cities, the donut outside of the urban cores is red hot. The exurbs, especially the deep exurbs, super red hot for a lot of these markets. But as you
Wow.
get to the very urban cores of these cities, some of them have, seen a bit more price give up or more softness.
Hmm.
And I think some of that is still, the work from home effect kind of playing
Yep.
out.
I like it. Very cool. Well, that was fun. Again, that's the kind of data you get here. It really tells you what you could be doing. And if, again, if my market was red or my zip code was red, that would be a green light to write aggressive offers. So thank you for that. The next county we have is actually in Indiana. It's Allen County, Allen, Allen County,
A
L
L
L
L E N.
E N in Indiana.
Did I spell it right?
That's how it's spelled in my,
I'm in the
yeah.
metro state. That's why.
Oh, yeah, that's the, there we
Okay. Oh, it's a bigger county.
go. All right, there you go.
Um, the market has seen some more inventory growth there. Where is that market?
No idea.
Oh, Fort Wayne. Okay. Let me go look at the raw just to take a quick look at this market.
Perfect.
One second.
Hmm. There it was. Up,
Did I miss it?
you did. Up, I saw it. There it is.
Yeah. So it's an interesting market where prices are still moving up. It has gotten some more resale inventory growth. Give me a second to try to figure out what's going on.
Okay.
Well, we could maybe move on to another example. I might want to do some
Poke
more
at that
dig
one.
later. Oh,
Very cool.
okay. Let me see it real fast. Because sometimes if you just take it, you can figure out what's going on. Okay, what happened in that market is that it very quickly got closer to pre-pandemic levels in 2022 and then has since leveled off, right? There's
Right.
not been much more inventory growth. And so that's probably why you continue to see prices move up,
Yep.
even though they had more active inventory growth because they're not skyrocketing, right? Like the market, saw the mortgage rate shock. They got a bit more supply on the market as demand pulled back. But then since then, for the past 18 months, this market's really been stabilized.
Yeah. Yeah. There's been a lot of areas that kind of had a bump in 22, but then re-baseline. So very, very cool. We got the next one. The next two appear to be in Texas. A lot of Texas investors. First one, we're going to go to Kenny, Bell County, Texas.
Okay.
Bell, Bell
Where is Bell County?
Texas.
State.
And I'm kind of bouncing around through a lot of the different stuff I have. I probably should have kept the trackers up. Okay. Okay. So this is in a softer area, I would expect. Let's see.
Oh, up, up. There it is.
Okay. Oh, okay. Not as much down as I would think. So 1% decline year over year in the county.
Yep.
In a second. I'm going to open my tracker back up. I shouldn't have X'd out of them.
Mhm. It's okay. We're doing this on the fly. It's all good.
Wow. Good amount of active inventory growth, 86% over pre-pandemic levels. Give me a
Wow.
second.
So you're up almost 100% rough and tough, but price year on year is only down 1%. There you go.
Another map. I think I might know. Just give me a second to open up another tracker.
It's amazing how much material you produce for a Resi Club.
Yeah. And then what I end up doing is a lot of times through the month, I put them together so that it's not sprawled out like this. But I didn't do a great job when I pulled up today. I was trying to show some more charts and got myself taken too far out. Okay, so I want to check this down here. There we go. Now I'll be able to pull through them faster. Make sure I got the ones I want. Okay, I got all three now.
Perfect.
Okay, so Bell County is down 3.4% from peak. They are up 86% for active inventory and just down 1% year over year. Actually, now I have another question. I want to go see what they did from pre-pandemic levels, actually.
There it is.
Okay, so I think the reason that they haven't seen as much price give up relative to some other areas in the Austin area is because, yes, they saw a lot of price growth, but they didn't see the real crazy price growth.
They
So
didn't
they're
see
only,
40% in 1 year.
yeah, so they're up 57%, let's say, on a 4-year basis. And that would be around 60. Austin and some of these areas that have fallen over 10% were kind of closer to the 70%, 75, 80%.
Right.
So they've seen a lot of appreciation, but it wasn't as crazy. So I think that's why they've been able to kind of stomach more of this bigger uptick in active inventory growth. I wouldn't be surprised though, if you go through the market, there's probably some patches in different price tiers where there's more resiliency and a bit more weakness in some others. But I would
Yeah.
classify this market as flat.
Yeah, I don't know if you heard the daily financial news this morning, Lance, but there was a great stat from somebody who covers Austin. I think her first name is Danielle, whatever. He basically said 10% of active Austin listings have days on market greater than 200 days. That's wild to think about.
And I bet I could tell you exactly why. It's
Nope.
probably because that is a market that has seen some price give up from the peak. And there's a group of sellers who are like, I want what my neighbor got.
Exactly. I call those stale listings. That's what I call
Yeah.
those.
And because, even in a market like Austin, which has seen the most price give up in the nation, only like 1 or 2% of the market is underwater, right?
Right.
It doesn't even
Correct.
stick out nationally because the thing is that peak in Austin happened so quickly and was over so quickly that there was barely anybody who bought. at that
Yeah,
time.
barely anybody got. Yeah, exactly.
Yeah.
Exactly.
And then, the fact that the seller is still, the unemployment rate there is still around 4%.
Mhm.
Vacancy rate for single family is low. So there's not a lot of distress in the market. And so some of those sellers, if they want to be stubborn, they probably have the financial means to do it. And so I
Yeah.
think that's probably what you've seen there is
Yeah.
they accept reality.
Yeah. So hopefully what people in school community are seeing is Lance Lambert Resi Club has an amazing amount of data, can really hone in on your county, your area. We got a couple more to go through. We got 15 minutes or so. The next one was also in Texas from Randy, Rush County, Texas.
Okay. How do I spell that one?
Rush, Rush.
RUS
SH. Yep.
County, and it's in Texas.
That's what I have. Yes. TX.
Okay, give me a second. I gotta see where it's at. Oh, it's with a K?
What do you mean with a K? I just
Is
have
this
Rush County, Texas is what I have. And if
Rush
you,
with,
I have RUSH from Randy.
okay, okay, I'll put it in that way.
Oh no, RUSH.
R
Sorry.
U S
SH. There it is. Rush
Rush.
County, Texas.
Oh, so there's a Rush and a Rush. Okay.
That's what I have. Maybe it was mistyped.
I think it might be Rush County. I'll
Oh,
go in there.
okay. Might be mistyped. You never know. Let's see if
Well, I'm
Randy.
in Dukes County, so we'll see.
Okay.
Give me a second to find where it's at. Okay. I think it's okay. Okay, this market is still a little tighter. So it's down 44% for active inventory. So let's go see what prices have looked like there. Oh, I think I saw it.
Down. There it is.
Percent. Okay. Well, wait, where was it again? Okay, so they're essentially still at all-time highs though for the market.
Wow. Okay. Very cool. Any more on Rusk? Got two more we'll try to get through before we.
Let's go through some of the other ones.
Yeah. How about we'll do one for Millennial Mike. We'll do Gary, Indiana, which is Lake County, Indiana.
Okay, I can find that one. Okay, there we go. So
Yep.
active inventory has grown more there, especially relative to Illinois. It's down 13.1% though. And let's go over here. Let's see what it is from peak. Huh, still
Wow.
still up. It's actually 7% higher than the peak. Now, this is the middle of the market. So the
Right.
bottom third can be a bit different. The top third can be a bit different. And let's go see year over year. 5.8% year over year growth. So still a bit below pre-pandemic active inventory level and still growing on a year over year level for prices.
I like it. All right. Very cool. We got our first Florida from John, Gainesville, Florida. Gainesville.
I can find Gainesville, I think, too. What county is it, though?
What was that?
Do you know what county Gainesville's in?
No clue. Sorry. If it
Right
doesn't
around.
say, yeah, I'm sure.
Let's
I
just
don't know.
pretend it's this county.
There you go.
Okay.
Sounds good.
Just a hair below peak. And let me see what year over year is. Just a hair above positive for year over year, pretty much a flat market. And they are a place that has seen active inventory get back above pre-pandemic levels. So they've kind of, I would call that softened.
Yeah. Yeah, I
Not
think
not
there's
a
this.
correction really. It's just more of a softened market.
Very cool. Why don't we try one around Atlanta? We'll do Cobb County. I'll pick Cobb County. There you go. Oh, left, I think. Yeah, there it is.
Okay.
Oh, yeah.
Still down 45% uh, for actives. And let's see. Okay, still positive growth year over year for home prices. Or actually, that's 4.6% above peak. Sorry, I'm on the above peak one. And year over year, let's see. Okay, so this market is up 5.3% year over year, 4.6% above its 2022 peak, and active inventory there is still what I consider a tight resale market, down 44% from pre-pandemic levels.
Very cool. Well, let's get our first in New York. We got some New York investors looking around Suffolk County. Probably mispronouncing that horribly. There
So
you go.
Long Island, okay. So Long Island, tight resale market, I believe, because they're up 8.4% year over year. And for perspective, nationally, we've averaged about 4.5% over the past 40 years for home price growth. So I would put that in the pocket of elevated. They are up 7.4% above their 2022 peak. And let's see what active inventory looks like. I don't know why it's not. Down 59%
Oh, wow.
from pre-pandemic levels.
Oh, okay. Very, very cool. Well, Lance, this is a lot of fun. Where, if
And,
somebody wanted to get, oh, go ahead. Sorry.
and the other thing I was going to say is New York City is actually one of those examples of a market where in the Northeast and Midwest, the urban core has actually been fairly soft. So Queens is back to pre-pandemic levels. Brooklyn is, Manhattan is. And then if you go look at pricing there from peak, those markets are actually down. Brooklyn, Queens,
Oof.
and uh, and Manhattan.
Yeah. This is amazing stuff. The audience, hopefully you've got a taste. I'm sorry we couldn't get to all of them. Um, did my best to get through them quickly.
The last
Lance,
thing I'll
this,
just point out real quick is that, and then outside of that, despite the fact that there has been more softening and correction in the core of New York City, if you go out to Connecticut and New Jersey,
yeah,
those are the hottest markets in the country since rates have went up. And so a
oh,
lot of
crazy.
parts of New Jersey are up 10, 15% above where they were in 2022 peak, despite the fact rates have moved up so much. And the last thing I was going to say is if you want to subscribe to the REI Club newsletter, you just Google ResiClubAnalytics.com, go there, type in your email. You'll get around 5 free stories a week. Lots of data, lots of charts, lots of maps. And then if you want to get the premium access to my trackers and my additional couple deeper dives per week, you can do so there with REI Club Pro.
Yeah, ResiCode Pro. If you want to get into your buy box, you're shopping around, you're trying to figure out what's what. This is the place to go. He has the data like no others. He does the interactive maps, as you've seen. Lance is my go-to guy for this. Lance, any kind of closing thoughts as we wrap this up? Thank you again for coming.
Yeah, if anybody wants to get a discount on Pro, I can do a 40% discount. Just email me lance@resiclubanalytics.com. And if you can't get
Wow.
me email Zuber, and that would be a lifetime discount.
So wait, so say that again. They say Zuber and they get a 40% discount?
No. If they email me, I will send them the link to get the discount. But it's lance@resiclubanalytics.com. But if they email you, Zuber, I can give you the link and you could give it to them.
Okay, we could do that. All right, all right. Lots of people got my email.
Yeah.
I did not expect that, folks. Frankly, I didn't even know there was a 40% discount. So another treat for the school community if you haven't got it already. Lance, you're amazing. Thank you for doing this. I know you have a crazy schedule. I'll let you get after your next thing, your next interview. Keep being awesome. Thanks for everything.
Yeah, thank you for having me, Zuber. And you guys are so lucky. Zuber is the best. He is. It's amazing how much he puts into this and is willing to share and give back.
Yeah, I appreciate you. Thanks. Look forward to the next Zuber letter. Zuberletter.com. Go there. Weekly emails. It's amazing. Take care, everyone. Have an amazing day. Later. Bye.